with Ryan Oake. He's a mortgage broker with Oake Mortgage. And right now we're going to be going through the difference between fixed and variable. This is a lot more of a meaty conversation, so Ryan's going to start off with just like the basic definitions of fixed versus variable, and then he's going to go into an explanation of how the two of them play out. So, Ryan?
So hopefully I don't lose you guys with this demonstration, but we'll start off very basic first. Fixed versus variable. What is a fixed rate? What is a variable rate? So fixed rates, it's a set interest rate for your specified term, and that's what it is for the entire time, will not change, and it dictates what your monthly payment is. Variable, you're always going to have your discounts or your premium, but the prime rate can change throughout your term. So your payments could go up, they could go down, and there's a possibility for that technically to happen 8 times in a year, although it's unlikely that you're going to get 8 changes in a calendar year. So,
I'm so sorry, Ryan.
Yeah.
What is a prime rate? Like, what is it tied to? What do you mean in terms of like eight times it could change?
So the prime rate is what the banks set as their prime lending rate to consumers, clients, people like us who are going to take a mortgage on. The Bank of Canada sets the target overnight rate, which is the interest that they charge the banks to loan money across different financial institutions. So if the Bank of Canada raises that interest rate, the banks usually pass the cost on to the consumers by increasing their prime rate. So if your prime rate increases, you're going to have a change to your net variable interest rate during your term. If the Bank of Canada lowers the rates, then the bank generally lowers the prime rate.
Gotcha. So the variable rates are tied to what the Bank of Canada does, because then the banks will follow and charge accordingly.
Correct. It's not a guarantee and it's never an absolute. Some banks have higher prime rates right now than other banks, but generally speaking, yes, when the Bank of Canada raises or decreases their rates, our banks do the same.
Gotcha.
So I've got a couple examples here. I just want to show what these different rates would look like in different examples here. So we've got a $400,000 mortgage, 2.5% fixed interest rate. We'll just say that's 5 years for argument's sake on a 25-year amortization schedule. That monthly payment is going to be $1,791 just for the mortgage. The second example down here is the exact same information except a 0.5 percentage point increase to 3%. That 0.5 percentage point increase is going to make your new monthly payments $1,892. That 0.5% increase is $101 a month for 5 years, which is 60 months. So you can see that adds up over the life of the term. But if you had that rate, that payment is not going to change, and neither is this one. So if you did want to see potential savings throughout the mortgage, and you're willing to take that risk that the rates might go up, they might come down, a variable is probably the rate that is better suited for you. So I've got P here. That represents the prime lending rate of the banks. Currently it's at 2.45%. Mortgages usually have discounts, so -1. Home equity lines of credit or revolving credit usually have a premium, so I've got a +1 here for an example. That interest rate would be net 1.45%. Prime 2.45 -1. Prime 2.45 +1, 3.45%. So like I said, the prime can change, but your discount or your premium will not. So that's where you're going to see the changes in your variable interest rate. Like I said, the Bank of Canada meets 8 times a year, and they make an announcement on what they do with their target overnight rate, which influences this prime rate. So that's why I say 8 times in a calendar year.
Gotcha. So then in a fixed rate situation, so scenario 1, we're working with 2.5%. So if you've locked in 2.5% on a 5-year term, this is what you're going to be paying for that whole 5-year term.
Correct.
So people, I guess hypothetically like that, if they just want to know exactly what they're paying for 5 years, like no risk, this is it. This is what I'm paying. Is that right?
Yes.
Okay. And then in this situation, we're just showing an example of like if somebody locked in at a 3% rate, like what that change does to things, which is essentially $101 per month.
Correct.
And so for the variable, like at least to me in this example, it looks like the variable rates for mortgages, at least, assuming that's also for a mortgage, is usually lower Is it always the case that variables are lower, or has there been a time where variable is higher than fixed?
Generally speaking, in the last 10 years, variables have been lower than fixed rates. Right now, while we're filming this, variable interest rates, they are at 1.5%, and most banks are at 3%. So you're getting a 1.5% savings right now with a variable. Now, there's lots of talk. The Bank of Canada wants to raise the target overnight rate. We could see 4 to 6 increases this year. If they did it a quarter of a percentage point every single time, we could be looking at 1 to 1.5% increase to this rate. But even then, it's still going to just bring you back up to where the fixed is right now. And you do have the ability for the rate to go back down because, as we know, 5 years is a long time. And just because they're going up this year doesn't mean that they can't come down in years 3, 4, or 5. So you're correct in saying that if you want stability and you're not the one that's in the stock market and you're buying and selling things and you hate fluctuation, fixed rate is probably the way to go. If you're okay with a little bit of risk in your life and you're not bothered by potential increases to what you're paying, then the variable is probably the better way to go, especially when it comes to penalties.
But I guess too, it's like, yeah, there's higher risk, but there's also a chance for higher reward. Because like you said, if they don't increase it, if it's lower to start, then you could actually be doing better off in the long term. Like it's possible.
Correct. It's not like there's no reason to think why if you had a 1.5% savings in the first 2 years, even if the interest rate was a little bit higher in the last half of the mortgage, your savings in the first 2 years are likely still to outweigh it, depending on how close the variable is to what you would have been able to take when you first got your mortgage.
Okay. And so before we move on to like penalties between the two of them and breaking your term, I just kind of want to go into this. Like, so this situation, like where you're getting a discount is typical mortgages. This is typically a home equity line of credit, so a HELOC. Can you just break down like the reasoning why a HELOC is usually more?
Right, so usually with home equity lines of credit, your bank is only going to charge you a minimum payment of interest only. So you don't have to pay back any principal. They just want to make sure that you're paying the interest every month. You'll never pay it off if you do that though. So they're okay charging a little bit of higher rate. The other benefit of having a home equity line of credit where someone might be okay with a higher rate is you can pay it off and then re-borrow on it again right away. With a mortgage, once you pay it off, you can't go back in and easily take funds back out that you've paid back to your bank. It would technically be a refinance. So the revolving portion at a higher rate is nice for people who may be paying it off, and then in that 5 years might want to re-borrow it again, and they're okay paying a little bit more because they've got access to the money.
Right. And actually, we did another video on this, like taking equity out of your home. A lot of that discussion is revolving around home equity line of credits and using that money to reinvest, say, in the real estate market. So I'll definitely leave a link for you guys to check that video out if you are interested. But okay, so next thing that I know is that there's very different penalties in terms of breaking a fixed versus a variable mortgage. So why don't we go into that?
So this one's, it's very complex. A lot of people ask me, what is my penalty? If you're in a fixed term, your penalty is either going to be what's called an interest rate differential or 3 months worth of interest. So for argument's sake, let's just say this $1,791 payment. For argument's sake, let's just say $791 is interest. You would be paying 3 months interest, so 791 times 3 for your penalty if it were 3 months interest penalty. If it's interest rate differential, you're actually going to be looking at a penalty that's dictated based on where rates are now with the bank, what your discount was when you got the mortgage, what your remaining balance is, and how much time is left in the term. I know it's
a lot of things.
It's a massive formula, and it's confusing for a reason. Because what happens is banks will, it's essentially what it works out is whether or not the bank's going to lose money if you give them back the mortgage you owe them, or if they're going to make more money by getting the cash back from you and being able to loan it back out at a higher rate. So whichever is greater, 3 months interest or the interest rate differential, that's what you're going to be charged on for a fixed term. Variable, it will always be 3 months interest no matter what. So one of the huge benefits, especially for first-time home buyers who might not be in their home for 5 years and they're going to be in there for 2 or 3 and they want to upgrade, the variable is way better because you know what your penalty is going to be. It's going to be insignificant, especially if you get hit with an IRD penalty. I've seen some people with a $400,000 mortgage having a penalty higher than $10,000, where their variable would have been less than $3,000. So it really can be a drastic difference. But like I said, 3 months interest on the variable, if you know that you might not be there for 5 years or you want some flexibility to move, that could be a huge option. One of the selling points for banks, because generally speaking they want to get you into a 5-year fixed, is they say, well, you don't have to pay a penalty, you can port it. And what a port means is you're basically taking your mortgage from the property you're selling and moving it to a new one. That being said, if you don't port it within a specified amount of time, your penalty is due. And if you port it and need an increase to what your balance is, technically you're getting a second mortgage with the same lender.
Right.
And your amortization schedules and terms might never line up, and you'd now be stuck with a penalty no matter when you left them.
Yeah, I had that happen to someone.
Yeah, so if you are in a 5-year term and you decide to port your mortgage year 3, and you have $300,000 that you can bring over, but you need a $500,000 mortgage, and that new $200,000 mortgage, if you do a new 5 years, you're always going to have a penalty because you're never going to have your two mortgages line up together,
right,
unless you do a variable or a shorter fixed term. So definitely things to consider, and that's one of the reasons why just picking the lowest interest rate right off the bat is not the first thing you should be considering on what mortgage you take on.
And so, sorry, can I just go back to the porting thing? When you port, do you have to port between your same bank? Like if you're with RBC, you can only port and get that second mortgage with RBC?
Correct.
Okay, so port has to stay within the same bank.
And generally speaking, you pay your penalty, and then if you do port it, they'll reimburse that penalty. So technically speaking, you're paying it up front, and they'll discount you on your next mortgage when you move. If you do it within a certain amount of time, they'll give you your penalty back. So I wouldn't rely, the bottom line is I wouldn't rely on the ability to port as a fail-safe for saying no to a potential variable which is going to charge you a significantly less interest rate.
Right. Okay, that's an awesome explanation. And so I guess like recapping it all, pros of fixed, just generally, what would you say the pros of doing fixed mortgage are?
Well, there's shorter terms, obviously. You can do 1 year, 2 year, 3 year fixed. So that's very, very nice for some people, especially if they know they're going to be selling the home in 2 years. They don't even need to take a 5-year variable because they know they're going to be out of there.
Right.
The other thing is stability. You know what you're going to pay and you know what your interest rate is, and it's not going to change. That's very important for people.
Yeah. Obviously,
the disadvantage is potential penalty and if you get stuck in a messy port.
Well, and I guess too, and you can correct me if I'm wrong, but you are taking the safe route, and if interest rates end up being a lot lower, you're still locked into this higher rate for that whole term, right? So you don't get that reward portion of the variable rate.
Correct. We've been in low interest rates for a very, very long time now. And interest rates at one point in the last 24 months were below 2% fixed. So people have been dealing with potential increases to the fixed rates over the last little while, but not too long ago, interest rates were 3.75, 4% fixed. So if you locked into a fixed rate when they were that high, you are completely removing the possibility of you being able to take advantage of lower rates during that term.
Mm-hmm. Yeah, so it's kind of like a double-edged sword. It's like you get your pro of having that stability and locking in that rate and not having to worry about it, but at the same time, it's like the same downfall. Okay, so then variable pros and cons, just general recap.
The variable, the pros, you're not locked into that rate. So like I said, if they go down, you get to take advantage of that. The penalty is always 3 months interest, which is nice. Con, if the variable rates start going up, your monthly payments could be more. Now, I don't want to give too much information here because this is a lot to take in initially. Variables you can lock into an equivalent fixed term. So if you had 3 years left on your variable, if you had 3 years left on your variable term and you wanted to lock it in, the banks will offer you whatever they're giving new clients on a 3-year fixed. So there is the possibility to save yourself from rapid increase, but like I said, if they go back down later in your mortgage, you're already locked in. And those would be the main pros and cons for the variable.
Right, and so with that variable where you're saying you can lock in at the fixed rate anytime, it's like you can ride the wave as long as you want and kind of take advantage of the lower rates, but if you really feel like they're starting to creep up, you do have the option of switching to a fixed. whereas you don't have that option of switching from a fixed to a variable. Once you're in a
Correct.
fixed, you're in a fixed.
Correct. And the main point to remember with that is you're not locking into what your variable is at that time.
Right.
If you have 3 years left, the bank's going to offer you an equivalent fixed term. So you're not locking into what you have, but you do get to lock into a fixed interest rate that they're offering new clients.
Cool. Well, I think I learned a lot. Hopefully you guys learned a lot too. If there are any questions that you have for us, or you want a little bit more in-depth of your personal situation, then definitely feel free to reach out to Ryan. He's one of the best mortgage brokers around, and we offer our clients his services quite a lot, so definitely feel free to reach out to him. And if you guys do have any other questions, or you're looking to get a pre-approval and get the real estate process started, then keep us in mind. Have a good one, guys.